Today I'm talking to Jon O'Shea, tax partner at Haslers, and we're talking about the changes to dividend tax that come into force in April 2016. So Jon, can you tell me firstly, how will the new tax work?
Yeah, so as you say, the new rules come in from April 2016, and it's a fairly fundamental change, to be honest, in the way dividends are being taxed. Three new rates are coming in, 7.5% for basic rate taxpayers. It's 32.5% for higher rate payers, those who pay 40% tax, and the additional rate payers, the 45% taxpayers, is going up to a whacking 38.1%. However, it does come with now a £5,000 dividend-free allowance.
So how does this differ from the current way in which they're taxed?
In essence, it's a tax grab. It's an extra 7.5% on all dividend payments, but the people probably it affects most are those who are in the basic rate. So the sort of small family company, you've got a husband and wife situation who are taking dividends out and only using up the basic rate band, they could be facing a tax bill of up to £5,000 a year extra compared to the previous year.
So are they the ones that are most likely to suffer, or is it bad news for everyone?
I mean, it is bad news for everyone, well, not quite everyone, because hypothetically there will be a group of people out there who have dividends that are just below £5,000, they'll actually be slightly better off. But the reality is everyone who's in business on their own, who's taking dividends out as one of their income extraction methods, is going to be worse off in the future.
So what can people do to minimise the effects of this new tax?
Well, that does vary enormously case to case, but there are ways in which dividends can be avoided as part of the extraction technique. And really every case has got to be reviewed on its own merits, depending on the number of shareholders, family situation and other balances in the company.
So your best advice is come and talk to you?
Absolutely.
Okay, thanks Jon.